Good afternoon to everybody. I'm very happy hosting today this SAFE-CEPR policy web seminar. And today we are talking about financial resilience as flood containment. And this is a work, in some sense, produced and will be presented by Enrico Perotti. He is a professor of the international finance at the University of Amsterdam. And Enrico is interested in big picture questions in political economy, microfinance, banking, corporate finance, organization theory, and historical discontinuity in legal and financial history. So clearly it's very broad, but today he's going to tell us something about banks and how, to improve financial resilience in banks. And he will present his recent work on this topic. And later on, we will have Mathias Dewatripont, that I know that all of you knows. He is a professor at the Université Libre de Bruxelles. And he was also executive director for several years at the National Bank of Belgium. He was, also participating as a member of the Basel Committee on Banking Supervision and on the supervisory board of the European Central Bank. He published a lot of articles in international academic journal, and in particular, a book that I'm, very familiar and I learn a lot, that is the prudential regulation of banks. And he clearly will comment on what Enrico is going to present to us today. And given that we want to maintain, the time, I'm giving immediately the floor to Enrico to start on his presentation. So thank you very much, Enrico.
Thank you, Loriana. Thanks to Mathias. Thanks to CPR for organizing this. I'm looking forward to this. These days, I'm also a part-time advisor to the board of the Dutch Central Bank. So what I'm saying does not implicate anyone but myself. That needs to be said. So I'm going to start immediately with my slides. The idea here is to take a certain conceptual approach that I develop in various papers and models and narrate it using an analogy that I find very compelling. Essentially, I want to spend a moment thinking about how we can deal with the current situation in which we face every day surprising shocks, things that we hadn't anticipated. We spent in financial regulation a long time trying to create proper barriers to withstand instability. We now realize that we often cannot calibrate them right, or we cannot set them high enough. And in a sense, if we cannot contain all shocks, then we have to learn to deal with them. And here I'm trying to learn something from dike hydraulics, which I will argue has a similar dynamic than bank runs. So let me just cite, first of all, our friend Marcus Brunnermeier in his presidential address, in which he talks about the notion of dealing with instability as being made of two parts. We've relied a lot on resistance. You create barriers and so structure that are able to withstand shock and contain them. But more often nowadays, there are shocks that we don't contain, we couldn't anticipate, they're too surprising or large. And then what becomes critical is our capacity to cope when indeed the shock comes and overcome resistance. So you could imagine a system being hit and just suffering the loss forever. That's a system with no resilience. You can think of a system in which after a big shock, things get worse. That's a negative resilience. And of course, we're looking for something positive that we can learn from. So let me go straight into banking and raise the point that I've raised already in last year in another webinar. Are we at the mercy of run? I mean, there is no question that we've done great progress since 2008 in building more solid barriers. Buffers that we have established for banks have provided solid resistance, even when rates went up. In Europe, banks held well, at least in the European Union. But what we've seen time and again is that once this stress starts, our system is not very resilient, and I will have a very specific diagnosis for it. If you look at what happened in 2023, we had outflows on some large banks that sort of gradually built up and turned into big runs and default. And that will happen from time to time. But what is frustrating here is that it was well known, and for at least a year, in case of some of these banks longer, that they were struggling or in a weak position in terms of business model or capitalization. And there was really a shocking degree of hesitation on the part of supervisor to intervene before the final run. Once the run comes, of course, you go into resolution and in the end, bailout, at least in the case of the US. Now, why do supervisors delay intervention, or at least visible intervention, decisive intervention, so long? I spent 2 years talking very much throughout the institutions, and two things emerge. I'm going to talk about only one of them. In the work with Martino, I talked about this issue of legal uncertainty over precise what the mandate is, and that was a big problem in Credit Suisse. I think the Swiss framework was very solid to contain distress, in the end avoided default, but it was weak from terms of the legal mandate, and that proved to be fatal. Today, however, I'm going to talk about the second problem, which is that hesitation to act due to fear of triggering runs. An example is activation of CoCo conversion, even suspension of coupons. We have completely failed in Europe since the beginning of the introduction of CoCo to ever activate CoCo outside of default. So, and it's clear that the hesitation has to do with fear of a run. Now, there are more measures according, if you look at the historical study about bank failing, you can see that up to 4 years before the actual failure, you can start seeing things looking bad. And if you look at the history, you can tell that before a bank actually fails, you can see for some time the problem. And the question is, why don't we act before? And the answer is, that I would give, is we end up with this forbearance gap because essentially people are very concerned about triggering a run. So what happens is we forbear, we hope the problem goes away. We end up, we do things, small things that are insufficient, but we don't dare to do the tough intervention, such as. And so this gamble on the regulatory side matches the gamble on the shareholder side. They also don't want to put money. In the end, if you delay too long, you end up with worse losses, because it's very clear if you allow a bank that is in a bad position to keep operating, things get worse. Now, how do we can protect the recovery of viable banks? We do understand that allow banks to keep operating while things are getting worse is going to create a larger problem. So what I'm going to talk about today is we need to how to contain this threat of triggering runs that then escalate. Remember, outflows is not the same as runs. Some outflows are to be accepted. It's the escalation outflows that kills the bank. So we're going to take a page from legislation on money market funds in the US, which relate to essentially the same kind of financial instrument that uninsured deposits are, money market funds targeted at non-retail. So let me start with an impression. So this has just happened. In New York, there is a terrible traffic experience, and after a long time, they decided to do what London has long done. They create congestion charges. At a certain time of the day, you'll have to pay to drive into Manhattan. And guess what? Results are spectacular. The speed, the average speed inside the city has improved significantly, and everything works more efficiently and smoothly. And so in a sense, what you've done is targeted with a charge an externality and contain it as a result. It's a bit like pollution charges also. So there is a literature behind this. There are in fact 3 published papers that I'm going to have implicitly in this discussion. And the last paper is the one that is still in the work in progress about using fees to contain run. Let me show you an analogy. I have to thank my partner for gracefully taking a pencil and drawing a little image of a dike. A dike contains, by its barrier, water on one side. That's what gives solidity or resistance. But what really matters once you have overflow is the condition of the dike on the back wall. That's the resilience part. So I'm going to share with you some of the stuff I learned. So first of all, dikes are calibrated to withstand water pressure. And once, however, you start to have overflow, the overflow erode the dikes. What is interesting with dikes and water is that a flow is self-reinforcing. So once water starts to move forward, it will pull water behind. And because the water falls behind the dike, it will accelerate. And that's what starts to have the escalation process that resembles exactly the effect you have psychologically on outflows, pulling outflows. And just as a bank run is very costly, so is a dike breach. Now, I spent some time on looking at the journals of hydraulics and dike engineering, and this is a lovely example. Here you have the water on the right side of a dike that is being overflow. And what you see is the stages of erosion. At first, you have gradual erosion. If you don't do anything, the flow accelerates. At some point, it starts to dig behind the back of the dike. Once you have sliding, you really have acceleration of the flow, and then the dike is lost. Once you allow that escalation to come, the inflection point is reached, the run will be completed. So in my paper, there are tables like this that try to draw the parallel between dikes and banks. Just there is an early stage of early outflows. If nothing happens, the outflows, they may go away, but they might also, if they don't go away by themselves, they start building on themselves. And at some point they accelerate, and at some point they become unstoppable. I'm not going to read through the table. You can read them in the chapter. So once again, let's think about, you have dike engineers that take care of building the dikes, but they're also, the real resilience part comes when you have a flood alert. And what is critical in dike protection as much as bank recovery is the speed of intervention, because both are explosive process that, if they're not attended early enough, will just build on themselves and they become unstoppable. So when the supervisor is ready to intervene and take some step to act on a bank and something start to, some people pull out, you have to ask yourself, is this going to escalate? Let's think of what happens in the case of a dike. Well, you mobilize what Brunemeyer called the redundancies, the reserve, sandbags, trucks. You try to slow down the overflow. You try to channel it. You try to buy time for further steps. So even in case the bank may ultimately not cease to be an independent bank and sold to another bank, it is important to have a bit more time than 24 hours to arrange these enormous operations. So buying time at the very minimum would be a very useful step. Of course, the real purpose is stop the escalation. Okay, let me talk a bit more about dikes. I've had so much fun with this. So the speed of flow, of overflow, depends on the back wall. So not on the capital, because that is already being overrun. It's the quality of asset, and to some extent also the ability of this asset to stem the flow. So a good dike is a wide dike, say the Dutch. And so that's really has to do with this, how much how much capacity there is to hold the overflow before it speeds down. The other thing, and this is going to be the key trick, is the profile of the back wall. Basically, I'll show you how for thousands of years, people that build dikes have been building steps to slow down water flow. So once again, let's look at the steps. Once the floods start, you start to push material into the back wall. You put sandbags, you redirect flows. You try to disrupt it through step spillways. I'm going to say more in a second. Reassure the population, if you can. Okay, what's the parallel with banking? Well, there are proposals out there to stem the early outflow by preposition collateral. That's, of course, it's going to basically move a material forward, but then after that, of course, you have a steeper wall behind because you run out of collateral. Conversion AT1 debt is probably the one thing that is a significant, large move that can have an impact, and certainly psychologically. There is a role of the central bank as a sort of absorbing of flood to a degree. And then the spillway, the step spillway profile is the same as what I would propose as redemption fee. So let me tell you how you can slow down flow with the step profile. Essentially, the step corners break the overflow momentum and essentially the chemical connection between the water molecule, introducing air turbulence. So this is a drawing which you see exactly how every time the water falls and bangs and slows, you have this sort of turbulence that disrupt the natural flow. Of course, I'm going to flow down fast. So this is a picture I took next to my building at the university. I was pleased to see evidence even next to my university. Now think of the biker on this particular bridge. Where is he going to go faster? Well, obviously on the smooth tail. Now imagine the bike going on the steps. Well, that would not be nice. But the same thing applies, in fact, to water. Now I'm going to ask your patience because I'm going to now change what I'm going to share. And because I couldn't produce a video into this construction. So let me share something else instead. Voila. Share. Oop. Okay, so what I'm going to show now is, oh, not this, obviously. I'm sorry. All right, now this is what you call a step spillway. You even hear the sound. So you can see how the mechanism works. Water accelerates naturally, but then is broken and disrupted in this process. Now, that's a step spillway. And this is something you find even in 1,000-year-old dikes. Okay, let's talk about the banking equivalent, redemption fee. Redemption fee would be activated once outflows start to appear to be exceptional. And then there would be essentially, so they are contingent and automatic, just as it is the case for US non-retail money market fund. And they will apply exclusively to uninsured deposit. Now, the result you have, we have a formal model that studies in a global game context, the run incentive. Redemption charges will reduce the incentive to run. So the probability of unnecessary run, the bad equilibrium in diamond debris, diminish. And you can, in our model, you can calculate exactly how much increasing a charge will slow down the run. What we do know is that the highest run incentive are under the conventional sequential service where you pay people at par until you run out. And my paper in RFS with Rafael looks at some alternative solution for that, which is gating. But gating is not really popular because gating really breaks the access to your own funds. Psychologically, it is quite terrible and there is enormous reluctance to implement it. So there is an alternative, which is that at some point you start charging a fee and you use the fee revenue to keep paying people. Now, this reduces runs for a very simple reason. The chance of default decreases. So the classic strategic uncertainty that you have in a run, where you wonder what other people are doing, is reduced. You understand that others are going to be paid, and so you yourself will be less, there is a lower chance that you won't be paid. And generally, this is the key. What you want to do is break this mental association with a run where, of course, others will run. What you need to do is disrupt that expectation. We'll also look at another case, turns out to be better, when you retain the fee. So let me start by showing graphically how you would use money. So in blue, what you have is the full amount of resource available to the bank. If he liquidates what he has, he will keep paying 1 for a long period of time until at some point it runs out. And at that point, a fraction of people will not be paid. You have default. And this is a context in which it makes a lot of sense to queue up, even if you don't need money, essentially. That's the classic bank run. Now, what if you start charging at some point, especially once you run out of liquidity, and then you use the revenue to extend the number of people that are going to be paid, that breaks down a run incentive considerably. And somehow the intuition is exactly this point. You reduce strategic uncertainty. People are less concerned about others running for 2 reasons. First of all, they get less if they run. But second, they also understand, well, also others will not want to run. So the direct effect is important. The indirect effect might be even large. Now, the problem with this approach is that it's almost too powerful. So in a sense, you can kill all inefficient run by a large fee, and we think a very large fee is unrealistic. So I think the optimum has to be somewhere less than the corner. So let me just show you, however, in general, how strong can be the effect. So what you have is theta here is the frequency of runs. And L on the x-axis is the liquidity of bank asset. As you can see, as liquidity falls, of course, inefficient run increase. And what the red line indicate the fundamental run. So you have too many runs that are really just driven by strategic complementarity. By a fee, you can considerably reduce that probability. And that is a significant gain because you're basically salvaging viable banks that do not need to be run. Now, there is a third possibility, and the one that turns out to be most efficient, and that's the case in which the fees are essentially set aside and they are assigned in case of default to whoever was not paid. Now, this has a different effect than the first fee. The first fee reduced strategic uncertainty. This fee instead directly takes away from the running payoff and gives to the rollover payoff. So it's a direct effect rewarding the one that stay home. This turns out to be the most effective because essentially you are really strongly reducing the incentive to be in the queue. When you put the fee back in the queue, in the end, the money will be in the queue. Now you take away something and give it to the one that stay home. You subsidize the one that roll over. So that's essentially the idea. One advantage of this is that you're creating a bit of a strategic complementarity in the right sense. If more people run, well, there are more fees. Now, that's not enough to fully compensate, but that's the reason why this method, you can achieve a very good solution in terms of reducing run incentive, even with a lower fee. So I think that in itself is important. Consider, for instance, the fact that imposing fees may have some external effect. You don't want the fee to be too large. Now, this is actually a formal model, so I haven't shown you no math. But what you can see here is the surface of run probability as a function of L. As you can see to the right side of the function, when L is very high, there are very few runs. And the purple pavement here is the efficient run. Those are the banks that should be run. And as you lower L, you see that the run probability increases steadily. Now, if you, on the other hand, start to increase delta, and delta is the fee, you see that you're countering that rise and bring it down again. Now, I have no expectation we can kill all inefficient equilibrium or that I can calibrate things perfectly, but you can see that the effect is actually quite pronounced, and all the more when assets are less liquid, as you may have in time of QT. Now, this is, let me explain briefly, this is the difference between the frequency of runs when you put money back into the queue and when you actually set them aside. As you can see, there are more runs when you put them back into the queue. That's what he's saying. What you see is the difference. This is essentially the increasing runs if you put the fee back into the queue. Right. There's going to be a paper on this. You can see that the optimal fee ideally is related to liquidity of asset. I'm going to go back, sorry for this, to the other presentation to finish. Right, so what we have in mind here is fees as automatic stabilizer, which are exactly the way in which they are conceived by the SEC when they introduced in 2023 these automatic fees. They would be only for uninsured deposit, only for those that should not be bailed out because they were never intended to be. Once again, the direct effective, do I withdraw now if I have to pay 3-5%? I'm a bit less inclined. Most important, do I think others will withdraw? Because in the end, the key to the better equilibrium is the expectation of the run. The bank is variable. I run because other people run. So we want to avoid those that don't need money run just because they think others are doing so, and this is a way to get straight to the expectation. How bad it is? Well, you're going to have reliable access to funds at a small discount in some cases. They're less disruptive than gates. As I said, one thing that is important to remember is that when the corporate account left Silicon Valley Bank during the run, they went into money market funds, subject to redemption fee. So there is a functional equivalence here. Of course, retail depositors would not be affected. Corporate depositors are subject to fees outside the banking system. No reason why they shouldn't be subject here as well, since these are the ones that would run. All right, so what do you get from it? So it's very important the fees are automatic. You don't want to have to make an assessment that might be questioned in court. They have to be triggered by outflow as opposed to any discretion or regulatory intervention. You have to just click on. And they would buy time to either restore confidence, change the narrative. Often what you do, you come up with some plan that refocus the focal point of attention of depositors away from the running to, oh, we are negotiating with another. Essentially, you create an alternative focal point that is consistent with recovery or at least not bailout. Okay, I've discussed the use of revenues. As we say in the end, the best thing is to tax the queue and subsidize those that stay home. Although strictly speaking, this is a congestion charge rather than a tax. Now, let me just maybe highlight for those who read the paper, the notion of contingent measures more generally. I mean, there are some contingent measures out there which are not really used, like bail-in as going concern. We don't use it. Use of all buffers is really a puzzle why banks are so reluctant to use the LCR or other things. There are certain proposals to ameliorate the structure. Our focus here is this sort of recovery regime matched with redemption charges. So in conclusion, we take this to be a more resilient view of how to deal with instability. Absolutely, delay intervention leads to a larger flooding. And here the fear run makes you wait too long. And what we need is to empower supervisors to do what they already actually can do. You don't really need legislation to do some of the things they are not doing. They just don't sometimes dare. And so the key point again, you have to make sure that you break the expectation of escalation on banks that deserve it. Of course, some banks that need to go bust. For that, you have a resolution. All right. Thank you for your attention.
Thank you very much, Enrico. You were very, clear on the mechanism. So if you can stop sharing, and I'm giving now the floor to Mathias Dewatripont. Please, Mathias.
Well, thank you. Thanks a lot. Thanks a lot first to SAFE and to you, Loriana, for the invitation. And thanks a lot to Enrico for a very clear presentation and on topics on which Enrico has written extensively since 2023 and in a set of quite interesting papers and policy notes. So in my 10 minutes, I will focus on a number of Enrico's punchlines, starting with all the things I fully agree with, and then discussing a bit some questions and comments on especially the redemption charges. So I think Enrico's starting point from Markus Brunnermeier, distinction about ex-ante resistance and ex-post resilience, and the link with flood containment. I think it's all very well taken. It makes sense. Basel III, when it is used, and let's remember that the US regional bank accidents were in fact due to the fact that Basel III was not in application for these types of banks. In fact, interestingly, Basel III is about internationally active banks. Now, by the way, Silicon Valley Bank had some little thing in London, but still was not covered by Basel III. It's only around 20 banks in the US that are subject to Basel III, 10 in Japan, not that many more maybe in China, but even though that I'm not sure, but in the EU, thanks to ever closer union, every bank has to fall under Basel, which by the way means that the biggest ones are not necessarily well covered all the time, and the EU is, I think, these days still the only jurisdiction which is not Basel III compliant, which is embarrassing, even though the fact that all the banks are covered, and in particular, every bank almost with at least a 30 billion balance sheet is directly supervised by the ECB in the European Union, has helped us. And so even though I'm not sure the Trump administration has learned that lesson, but clearly that has protected the European Union banks. And by the way, Credit Suisse is not the EU, not in the EU, but it is, of course, Basel III, under Basel III supervision. It was regulation and supervision. It was a global systemically important bank. So, but so basically, even though the Basel III has reinforced ex-ante resistance quite well, as Enrico said, resilience has been problematic. And in particular, what you saw is that there was a procrastination, in particular for Credit Suisse. So the supervision resolution part was not great. And then the fear of runs was there clearly in the US. And there, of course, the LCR wasn't there, which was a problem. But I think I'm fully in the same line as Enrico about the fact that we have this resilience problem. procrastination due indeed to a lack at times of clear legal intervention rights. So that is a key problem. And the fear of runs is there too. Now, about the solutions, and well, I had seen not only the paper, but also the extended number of slides before and all this. You went a bit fast on the fact that we still have a big problem with the slow and insufficiently informative accounting numbers, triggers, and that we would need, in order to react faster, which is indeed a very important, we should add some market signals, even though we know that market signals are volatile and at times excessively volatile, but I fully agree with that. Also, I think you said in another paper that although bail-in often doesn't work because it's too low and the trigger are too low and therefore it's too much in resolution while the key should be recovery. I fully agree with that. And that was one of the advantages of the successful AT1 bail-in in Credit Suisse, which was a game changer and allowed to not have a bailout. And I think that's very important. So in that sense, I fully agree that, I mean, some people think that we need successful resolution, orderly resolution on that. You know, resolution is never an objective. The objective should be that we need good incentives. We need to minimize bailouts, therefore. But, you know, I think Credit Suisse, despite the procrastination, I think it was a success. And in particular, because of this successful AT1 bail-in, even though shareholders should have lost everything. So the hierarchy of claims was not respected enough due to legal problems. But the idea that we need bail-in, credible bail-in of long-term liabilities is a good idea. And if it's long-term liabilities, we don't have to fear a run. Just like we shouldn't be excessively worried about a stock market crash triggering some runs because it's only a second, you know, it's a secondary market, so it's not money coming out directly from the bank. So that's okay. It's much less disruptive. So these guys are stuck. They can always sell, but they need to find an external buyer, and that's okay. The key question will be, you know, do we need to have some ambiguity about lack of protection or imperfect protection of depositors? And I will come to that afterwards. But the bottom line is that indeed, I think Credit Suisse was a success in the end. And of course, and in a sense, we need to thank the Swiss authorities for that. Huh? So Europe had some weak banks, and thanks to Credit Suisse being sold to UBS, we didn't have bank runs in the Eurozone. Now, of course, there are some caveats. First, competition. You know, now we went from two really big banks in Switzerland and to one. And so there is that question, but that's not for prudential authorities, but competition authority. But second, thinking about Europe, UBS was there. So there was another Swiss bank that was able to swallow Credit Suisse. You know, if Société Générale, whose I like to call that the market leverage ratio, so market cap over balance sheet, in SocGen today, it's 1.6%. So, you know, the stock market value of SocGen is 1.6% its balance sheet. For JP Morgan, the biggest US banks, it's 18.3%. You know, it's more than 10 times. Okay, if SocGen is in trouble, you can call BNP Paribas and maybe, you know, by the way, at some point they wanted all three to merge, BNP, Paribas, and Société Générale. If Deutsche Bank, another GSIB, whose market leverage ratio is 2.5%, you don't have another German big bank like UBS that could, and so, you know, already when you look at the saga of Commerzbank and UniCredit, you know, politics may get into the way. But okay, for the rest, I really agree that we need to increase resilience. I agree with Enrico about clearer legal intervention rights, more long-term subordinated bailable liabilities favoring recovery rather than resolution, and the addition of market triggers to accounting one. Now then, and he spent a lot of time on the issue of redemption fees, and I think that's quite an interesting question. There, I have a bit more question. You know, if we agree on everything, it's boring. Yeah? So we need to disagree on some things. Now, I take the point that they have been used successfully for money market funds in the US. But let's face it, money market funds, I think, have quite strong restrictions on the asset side. So somehow their liquidation value is reasonably high. They are close to what we call narrow banks, which is one reason why you don't have insurance. Now, banks, they take more risks. Normal banks, they take more risks, and they are not very transparent. And so I think the key, since you mentioned a lot Diamond Dybvig, the key is, do we manage to wipe out the bad equilibrium by when you have these redemption charges? Because if you don't convince people that the bad equilibrium is gone, then, you know, okay, I'll pay the 3%. And the more people withdraw, even though you may say, okay, the 3% will be used in order to pay those who haven't run, at some point it might not work. And so if indeed you don't manage to do that, what you really need is, in a sense, the Draghi, whatever it takes for the euro, i.e., in the end, you'll be fine, which is what we call a bailout or a deposit insurance. So, you know, that's also suspension of convertibility or the like that indeed we don't like, and you don't like, Enrico, and I understand. But and in that sense, I think there may be a difference with dams and dikes. Even though I like your little video about how these things can smoothen things out, but you don't have a Diamond Dybvig bad equilibrium with water where people might take the fact that all of a sudden I have this 3% redemption charge as really bad news. Something is wrong with my bank, and therefore it backfires. So my question is, you know, in your model, do you have that kind of problem? Because then, you know, I would think, you know, bank runs are so dangerous from the point of view of financial instability. You know, we've only allowed one example of not protecting depositors since the mid-1930s, which is Lehman. And Lehman was bail-in, and it was the costliest bank failures in the last 90 years for taxpayers, I mean. So in that sense, how I understand, and by the way, Lehman was an investment bank, which was not at the time under FDIC, so nobody was insured. We only applied the law for once, and then, oops, we won't do it again. So in that sense, I think beyond what you're suggesting, well, I would add maybe capital insurance a la Kasia Prajanstein, saying, look, you know, in bad macro times, let us give banks some help, and they pay for it in good times. And let's not do it with the private sector, which has limited liability. Let's have the state do that. I think this idea of ambiguity concerning deposit protection, which is still there, because technically there are uninsured deposits, even though in the end, except for Lehman, they never have to pay. So shouldn't we just admit that more seriously. By the way, even though it's not only for retail deposits up to 100,000 euros or $250,000 that we do it, in a sense, I think for interbank deposits, we are fine. For interbank deposits, we say 100% LCR outflow. So you have to back interbank deposits with high quality liquid assets. So that's narrow banking. So if you want to do that, that's okay. The problem of Silicon Valley Bank and the like is that you had big retail depositors or corporate depositors and so on with much, well, they didn't even have an LCR. But in Europe, in Basel, there, for these uninsured deposits, you have much lower outflow rates. And I think now, I don't think we want to go narrow banking for everything, but somehow I think it might make more sense to say, and I know some people hate the idea, but let me still say it. I think it's so complicated to modulate the probability of runs that maybe it's better to say, look, deposits will be bailed out. We just need to make sure that the bank either has a sufficiently safe asset portfolio or sufficiently limited, sufficiently long run term of the deposits. And for the rest, let's make them pay for deposit insurance so that in the end, there is no expected cost for the taxpayer. But as I say, right now, we seem to be unwilling to extend deposit insurance more, but also unwilling to have zero bank runs. And even though at the times exposed, we have zero bank runs. So my question.
So Mathias, thank you very much. You know that you are touching a point that here at SAFE we are proposing for already 2 years, pretty much. That is that de facto the bank deposits are insured because there will be bailout if there is issue. But let me go back, and I want just to stress there are already questions. So let me add also a few of these questions. One is, and then I give the floor to Enrico. One is, if these fees are preventing bank run, why banks are not already implementing this fee on, in terms of all this contingent redemption fee? And
yeah, I can see the question in the chat. If you want, I can.
Okay, so please. You can start also with the point raised by Mathias, how credible it is and how really is the problem solved with this contingent fee.
All right. So first of all, we will not avoid all runs. And I think let me just, I think we agree on the diagnosis. We don't fully agree on the conclusion. I think, let me start with a larger question. So when we go through QE, we say the central bank creates liquidity and then it will reabsorb it. What we have learned in the last years is that every time the central bank goes through a big move of QE, the banking system swells because, of course, reserves can only go into banks, and they create more runables and deposit. This is the work. So basically what we have is a system that when we do legitimate monetary policy, we are creating something that, if we accept the runs, has fiscal implication. So you are breaking the role of the central bank as a stabilizer, an independent stabilizer, because you are basically putting all of us taxpayers on the hook for the expanded scale promises the banks will do without backing. And I find it unacceptable. I think sequential service is something that is very effective in making people put money in the bank, but it's just too powerful technology. I think it is something that is legitimate to target the public support to those, to individuals, families, households, maybe small firms, as some proposals have. I'm utterly not ready to accept that we will always bail out. You know, it's not about creating uncertainty, it's about having clear rules. You want to have unconditional access to your money, fine. Either you go to a money market fund, where you have a redemption charges. If you're in a bank that has even less liquid asset, you will have the same condition. Why should we favor them there? There is no reason I can find. We don't need banks at all costs to store corporate cash. They can go into money market fund as they historically go, actually, because historically, corporate cash goes into accounts that have a little bit of risk, price risk, like money market fund, but, you know, a better yield. So let's accept it, and let's just put that functional. I just don't want to accept deposit to be something that is for large corporation to be the same as what we feel as deposit. We cannot afford to let people lose confidence in the banking sector. Now, it's true it's going to have consequence also, perhaps on the scale of banks. I don't know. It's not clear. I'm not sure that you had this effect in the US. But let me just disagree on accepting that deposit insurance is the solution, because as we know very well, risk incentive, and you're one of the leader in this literature, you know, where you put risk is going to determine the incentive. And if we put the risk on inactive depositors, we're not going to have sufficient discipline. Now, I agree with you that we could do more with LCR, so we can increase LCR, because obviously what we're currently estimated to be outflow of corporate deposits is unrealistic in the time of social media and other things. But I don't think it's going to happen. I mean, part of my effort here is to recognize that there is little appetite out there for strengthening buffers, whether capital, liquidity, or LCR. And because of that, we have to think of plan B. There has to be some way to make possible to contain moral hazard and, in any case, liquidity risk. I'm sure I didn't address everything. Let me look now at the question in the...
Enrico, I'm sorry, but you need to address then one point that has been also raised by Mathias. These contingent fees do provide an incentive to banks to take more risk, because, you know, if they are then subject to less run, you know, in principle, they can also take more risk as well.
Do you think the banks are constrained by fear of run in their risk choice? I don't believe it. I think they are counting on the fact that if the run comes, someone will bail out. But I mean, I really don't believe it. But let me answer the question in the chat, and we can talk more, Loriana, with pleasure.
Okay.
So Daniel says, why don't banks do it themselves? Well, I think any bank that would impose it unilaterally would be in serious trouble. I mean, there is a case why we do public policy as everybody's subject to this. I mean, it could be even that banks would like it, although I don't think so, but they would never do individually. There is zero incentive in a game like this to be the one that say everybody can withdraw a par, not here. Don't think so. That would be my quick answer. There is a question about automatically progressive increasing fee. Yeah, I mean, escalating fees would kill the escalation incentive, no question. I think the biggest problem with that is that once you create some discretion into the fee, you get into a huge problem. First of all, and let's just say legal, because you will always be taken to court, as every supervisor that ever did anything to a bank has suffered. You're taken to court that you've done too much, that you've done whatever. So the best thing is to take all discretion out. It's mechanic. Well, it is possible that you say, okay, after, say, 30% leaves the fees, moves to a next level. That's actually possible. But it would have to be as automatic as possible. Frankly, I think it would, however, possibly encourage people to try to be earlier on the fee notion, because you don't want the higher fee. Although I think ultimately the key point is to break what we have left there, this unconditional entitlement of corporate to withdraw huge deposits instantaneously, and then because everyone else will do, they do too. Florian, thanks for your question. Resource to placate depositors still comes from the banking sector. I don't think I fully understand the question. How realistic it is in an overall panic? Okay, that's a clear question. This is not a solution for a systemic crisis. If there is a major systemic crisis, I think these mechanisms will help a bit, maybe, but is no particular solution. This is very much on individual banks or cluster of banks. It would have been effective in March 2023. I think in September 2008, it would not have made a difference. Thank you.
Okay, so there is another one. I don't know if you see, if that is applied to any amount withdrawn, or so it's still related to the other. Do you want to have something in scale, or is it on the amount?
Yeah, I see it. So what is the trigger for the fee of uninsured deposits? Does it apply for any amount withdrawn, only for amounts withdrawn above the deposit insurance limit? That's a good question. I think the trigger has to be is not on the base of individual withdrawal, but aggregate withdrawal. So it would be simply once the rate of outflows passes a certain threshold over the stock of uninsured deposits, the fee is applied unconditionally to all withdrawal of uninsured depositors. I am not sure if any deposit is covered up to 100,000 under EU law, or whether the uninsured are totally uninsured. I'm left a little uncertain there. I suppose that since the principle here is that you don't touch upon the right of retail or insured depositors, you let them withdraw par all the time, this would apply to the full amount of any uninsured deposit.
Okay, so we are perfectly on time, and I'm very happy. I don't know if Mathias want to add something.
No, I mean, maybe very shortly, but by the way, I fully agree with you, Enrico, that it's not very acceptable to protect large depositors. It's the question is it feasible? The problem is that you have a revealed preference by authorities, and I agree with that revealed preference, that somehow if you think that a run will trigger, general financial instability and so on, you realize that in order to protect taxpayers, you just have a bailout. As I say, there was no bailout in Lehman, and it cost taxpayers a lot more. So now, interestingly, you said that you see redemption charge as a solution for individual or specific bank problems more than for a systemic crisis. Would that mean, because in a sense, my understanding is that the authorities in the US, they invoked the systemic crisis risk when helping Silicon Valley Bank. So in that sense, would you see that your suggestion, which by the way, I fully agree with, that it's somehow you're basically starting to tax withdrawals, and that mechanically helps the solvency of the bank. And
let me, on the Silicon Valley briefly, because you're right. I mean, once Silicon Valley started to have run, it was a time of acute stress, and I don't know what I would have done, frankly. So, but I think the point of fees is that they would have empowered and facilitated intervention a year before. That's the thing. No one did anything for a full year. The chief risk officer resigned Nothing was done. And and every month the report was published indicating how big the losses were. I mean, this was insane. Nobody did anything. So one of the reasons they didn't dare. So we need to empower Pillar 2 authority, because right now they're frozen.
I fully agree.
We will have maybe another, webinar where you are, we are discussing on how to empower the authorities to implement Pillar 2, because I think, that we need to be able to avoid the problem of, if you're doing nothing as a supervisor, do you have the same blame as doing something that then maybe is wrong?
I think if I talk to many supervisors, they won't say so totally explicit, but it's clear that they feel like they can do right in that moment, and doing nothing is actually the least immediately. Not doing nothing is also not fair, but doing little in a way that remains non-visible is de facto what they would end up doing.
Yes, so this will be another clearly topic that I suggest clearly to investigate. But let me thank you both, Enrico and Mathias. Yes, Mathias?
If I may, and I have a conflict of interest as a former supervisor, but not as an academic. And I mean, I remember Charles Goodhart saying once in a meeting that supervisors have the hardest job in the world, because every success avoiding a problem remains pretty much private, and every failure is hugely public. And so in that sense, I think, but so in that sense, everything that would help, and among Enrico's idea, everything which would help them have more intervention power would be good. So in that sense,
okay,
I think that's
very good. So thank you very much, and see you soon in another webinar. Thank you. Bye-bye.
Yeah. Thanks a lot.
Thank you, Daniel, for the suggestion of the book. I'll take a look. Thank you.